Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today, I'm delighted to have back on the podcast Dr. Christian Baylis, who is CIO and co-founder at Fortlake Asset Management. Thank you for joining us again, Christian. How are you today?
Yeah, great. Thanks, Liz. No, thanks so much for having me back again.
Our pleasure. I'm continually thinking back to our first podcast a couple of years ago, and in that podcast you said you thought inflation would come down quite quickly, but that it'd be much more difficult to get it back to within the RBA target range of 2 to 3%. It's really stayed with me. Can you please give us your thoughts now on the inflation journey, if you like?
Yeah, well, I mean, I think back at that point in time, the thought process was that we've got three critical stages of inflation, which are typically tied to the stickiest part of the inflation basket. Anything that's basically labour related tends to be sticky. And so if we sort of take that and back solve what sort of things we would expect to happen in that particular part of the inflation basket, we would expect people, number one, to start asking for compensation for past inflation. Stage number two, you'd be expecting people to then ask for compensation for current inflation. And then the final stage, which is the stage that I think we're in now, is you get people asking for future compensation for their perspective on inflation. And that ultimately becomes a very long, sticky cycle and tends to play out in a way that tends to have significant lags and tends to have, a much slower moving type of outcome than what we probably would anticipate. It's very undynamic in the way that it's resolved. And I think that was probably one of the things that became very obvious to me when particularly looking at a lot of the forecasts, where I think if you go back in time, back to 2021 and 2022, most people had inflation reaching 2% by the end of 2022, which was just remarkable. And so I think we really sort of got to hone our mindset into that particular part of the inflation basket. The labour component directly and indirectly makes up about 80% of the CPI between tradables and non-tradables, and ultimately it's a behavioural type of element, and I think it's just very hard to put an exact type of formula onto these sorts of things. So that's where I sort of see where we were and where we are at now.
So does the RBA, do we need to see higher unemployment for wage growth to start coming off, or is it more entrenched than that? We've seen the aged care workers get pay rises, and we've seen the childcare workers go, oh, I think aged care looks more attractive, I'm jumping ship there.
Yeah.
It must have some sort of compound effect.
Yeah, look, the RBA's got a very difficult job getting the CPI back into the target band. When you look at the RBA's remit, obviously one of the key things is fostering maximum employment, and I think that's always interesting because we often talk about unobservable metrics and these sorts of things. Maximum employment is an unobservable metric, and we only typically know it on an ex post basis, i.e. looking back in time. And so it's interesting that so many central banks have this remit which fosters maximum employment, but it is unobservable. So it's interesting that we also put so much weight on it, particularly when we've looked over the most recent past. It's quite clear that the models that typically draw the connection between inflation and the unemployment rate, such as the Phillips curve model and these sorts of things, the sensitivity or the delta between the two variables has really broken down a lot compared to what it used to be like. And so arguably there's a reasonably loose connection between the unemployment rate and inflation, despite I think the inferences that they're joined at the hip. We just have found that relationship isn't as consistent, and we can't rely on it as much. And so we've just got to be very very cognizant of the fact that when we're looking at unemployment, we're looking at it in isolation, just more as a contingency measure to make sure that we're not drawing false inferences. And so when we look at that in isolation, we've got huge amounts of migration globally. The US has obviously talked a lot about this as well, which is obviously increasing the labour supply pool. That has implications for housing and whatnot. We've also got skill shortages in particular areas because of policy. We've also got productivity issues, which is obviously heavily tied into labour market outcomes as well. All of these things, have significant implications for the price of labour. Then we've also got geographical things here, specifically like enterprise bargaining agreements, which are very specific to Australia. And when you compare Australia's, labour market to the more free market types of labour markets like in the US and the UK, who tend to have much more market clearing levels of labour, i.e. supply and demand driven outcomes for labour, i.e. their minimum rates tend to be rates which no one actually lives off, whereas in Australia, our minimum wages, which are around that $21 mark per hour as a rough rule of thumb, people actually live off our minimum wage, and we try to effectively have a through the cycle type of outcome for wages. And that also means that our experience with inflation will be quite different to those markets which do have those more market clearing levels of labour as well. So we probably have a less dynamic labour market from a pricing perspective compared to those geographies. And it also means that we've got to incorporate that when we're looking at monetary policy as well.
So it's really obviously then a different role. The RBA is going to have a different role, same role, but different set of circumstances to work with compared to the Fed and the Bank of England. How does it work to bring inflation down from here? What can it do? And obviously it's got this one big blunt instrument, which is the cash rate.
Yeah.
Can you see the cash rate moving higher from here?
Well, look, I think the interesting thing that we have to recognise is that we have to always consider the relativity of where the cash rate is to some sort of theoretical neutral real rate. I think that's really important. And we can't sort of crab walk away from this conversation about neutral real rates, because that's a bit like saying you want to drive the car at a set speed limit, but you're not willing to use a speedometer to do it, is that you're trying to basically adjudicate your own speed on feel. We work in an unobservable world. We work in a world where we have forward-looking outcomes. Central banks say they want to be data dependent, but you can't be data dependent. You have to have a view. You have to lean in to the argument about what is neutral and where it is, and you have to have a triage type of approach to trying to solve what that number is, despite its inaccuracy and despite the typical disclaimers around modelled outcomes and all of these sorts of things. Is you have to work with a speedometer of some type. And the best one that we currently have, unfortunately, is the neutral real rate. It's as simple as that. And so when we look at the neutral real rate and the estimates of it, that has to inform our decision of what we do with the policy rate as well. And we can use proxies, and going to this point of triaging solutions for these type of inaccurate models. There's nothing wrong with using proxies as part of that triage process, i.e. what is a proxy for the neutral real rate here in Australia? I mean, the 10-year real yield would be something of a pretty good proxy, and that's currently around 1.75%. In the US, it's at 2.25%. And that wouldn't be too far from our contemporaneous assumptions on neutral real. So we've got a 4.35 cash rate. Arguably our neutral real rate is around 1.75. And that's sort of when we look at the cash rate in Australia, you look at it 4.35 cash rate less, let's say 3.5% on inflation. We've obviously got inflation coming out next week, but let's use that number. That puts us at about 75 basis points in terms of where we're at versus a neutral outcome of say 1.75. And so the argument would be that we might have to do more on the monetary policy tools. We can definitely see a situation where monetary policy has to go higher, or we can work on the basis that the neutral real rate and the contemporaneous assumptions that we use, such as market-based rates and those sorts of things, actually start to fall and solves the problem for us by doing nothing. So you've got an inert outcome where you do nothing and the market solves the problem for you, or you've actually got a situation like what I fear we see today, where real yields are going higher and they are proxies for that neutral real rate. And that arguably means that we have to do more but it is always relative. It's never stagnant. And I think that's probably where I would probably argue the toss with a lot of central banks that don't want to engage in a proper conversation about this because of its inaccuracies, that it is such a relative world. It doesn't matter what the policy rate is. It matters what the policy rate is relative to that neutral rate. It's very important that we use that as our reference tool or our poll star to guide where we're at. And so I think that's where I sort of sit with it at the moment is theoretically speaking, we do have more to do. Central banks will also always want to talk about ex ante and ex post neutral real rates and these sorts of things. But the reality is, if you're looking at ex ante neutral real rates, i.e. Futuristic estimates of neutral real rates, our experience has been that we haven't been too good at forecasting where inflation is going to be. So in the current example is a point in case is we're now revising our inflation forecast higher, particularly in the US. We're now revising our estimates of cash rate cuts. We're pushing those out as well. And we've just got to be very mindful that this is a very inexact science. I think in the US, the estimated error on policy rates is around about 1.4 to 1.8 in any given year. So even central banks' ability to predict the future on policy rates is pretty wide and varied as well. So my sense is that we've just got to be very careful about what's happening beneath the surface. Is that neutral real rate actually coming up and moving up, and therefore making the level of restrictiveness in the economy not as what it seems, which is where I feel we're at. That's sort of where I'd sit with the current policy rate. So very strong likelihood that something has to be done, be it through an inert outcome where the real rate drops, or if it stays stagnant to where it is, we would actually have to do more.
Okay, that's a lot to take in. We need to do more. And we've got a budget coming up, and we've got government in place that wants to be re-elected and is saying it supports people, workers. How does that all tie in to what you think might happen?
Yeah, I think this has been something, or a bit of an element that we've seen for some time, where you've got the central bank having to do a lot of the heavy lifting. Obviously, the central bank, they're not elected officials, and my sense is that the politicians have been quite happy to allow the central bank and bankers to ultimately feel the brunt of community discontent in relation to interest rates and these sorts of things. But the reality is that the politicians aren't really helping the central banks at all in terms of their policies. We're still running reasonably large fiscal deficits across most developed economies and even in undeveloped economies as well. And we do have a bit of a two-speed approach to the way that we're conducting it, that you've got obviously tax cuts coming through. They're not huge at the margin, but they're ultimately not going to be supportive for what the central bank's trying to achieve, particularly in a world where arguably neutral rates are rising. And obviously when you're using tax cuts and these sorts of things, they're far more broad-based than what interest rates are. Interest rates arguably affect 3.3 million households. So not a huge wide dispersion of people are caught in that particular net, which also means there's a lot of people in the economy that benefit from higher interest rates as well. But tax cuts basically affect everyone. So when the government introduces tax cuts or shifts them from where they currently are, the broad-based nature of them does have pretty significant implications, and it is a more potent, I think, stimulatory tool than the cash rate for that reason, that it affects everyone. So I think that's the thing, is that, yes, we all understand why tax cuts have been introduced. We all understand why particular policies are introduced that reduce the cost of particular items in the inflation basket. But at the end of the day, all of the things that government is doing on that side of the fence, from what we can see today, in the main, sure, there's going to be exceptions, but a lot of the ones that are published in the media and that are out there, they tend to be counter to what the RBA is trying to achieve.
Okay, still on the topic of inflation, does it matter that our cash rate is so much lower compared to the US and Canada and New Zealand and the UK, other developed countries? Does that have much of an impact on our economy and the value of the dollar and imports, exports? Could you just talk us through that a little?
Yeah, sure. I mean, it matters for the currency and in particular the TWI. Obviously, that incorporates our major trading partners to the extent that you're running an expansionary regime and keeping interest rates low in a relative sense. That will fuel export growth and potentially overheat the economy in a relative sense. And that would at the margin deliver higher inflation over time. So I think when we look at it, compared to Australia's experience versus other countries, particularly our more significant trading partners. I think it's undoubtedly the case that we do have a lower cash rate relative to our estimates of neutral, and you do have places like the US, which are ultimately far more advanced along that path. They took a far more significant risk mitigation approach to monetary policy, i.e. when they realised that they had underestimated the implications of the pandemic and its relationship to inflation, they were much more aggressive in the way that they responded. Arguably, that has meant that they have had a much bigger delta on reducing inflation as well. So they've come down from much higher levels of inflation at a much quicker rate. And they're now arguably, I mean, what's interesting about the US's experience is their inflation is pretty much exactly in line with ours. Their unemployment rate is almost pretty much exactly in line with ours, but their policy rate is up around 5.3% versus our 4.35%. So it does matter what other central banks are doing, but ultimately it comes through in the currency, and that ultimately has implications for our inflation numbers as well through time, particularly through the tradable side of the inflation basket.
Okay, I can see it, and I've always been able to see it, inflation lasting and being much higher for much longer than we ever thought possible. Just looking at historic,
Yeah, and
you know.
yeah, and that's fair enough. You can take the slow and steady approach, i.e. gradualism, and that's what central bankers call a Bayesian way. It's a terrible word, I know, but the statistical word for that is gradualism. So if you're using a Bayesian approach to monetary policy, which is arguably that gradualist approach, there's implications for gradualism as well. Gradualism means that you're going to have a higher cash rate, arguably for longer, than if you used an approach which was a risk mitigation approach, where you jacked up the cash rate aggressively, got on top of the problem aggressively, and yet your speed of resolution is a lot quicker in that type of scenario. We've ultimately erred on the side of gradualism much more than other central banks, I would say, based on where our real cash rate is relative to neutral. And the price to pay for that is stickier inflation for longer. And that's just something that I think we have to get accustomed to.
So what are the implications for asset classes now going forward? Like, we see a lot of risk asset classes have really taken off. The S&P 500's up 20+% in 6 months-ish. Properties going gangbusters. And of course, bonds. Can you perhaps just talk through a little bit about what you think about asset classes from here, based on those assumptions?
Yeah, well, I think, yeah, so I think looking at equities in these sorts of places at the moment, I mean, it feels like it's heads you win, tails you win. On equities, which is a pretty good outcome while it lasts. Obviously, I think when we spoke near on 2 years ago, we had huge amounts of volatility in interest rates, and the argument back then would be that higher discount rate volatility should ultimately mean that you get more significant equity volatility, because obviously the discount rate is the primary function by which you discount your future cash flows. So arguably, if that's moving around a lot, the valuations of equities should move in tandem with that. Ironically, what we've actually seen is that equities just continuously move higher, irrespective of the cycle of news. I.e., they move higher on the soft landing, and then they move higher on the soft landing. No, but no longer being the case. I.e., we've got higher interest rates for longer. Equities have really taken that in their stride and just gone higher as well. And so it just feels like the good news is good news and bad news is good news at the moment in the equity market. But I think as we sort of move into areas which are closer to home for us, like private credit and these sorts of places, we are starting to see distress in particular parts of the market. In Europe in particular, we've started to see some significant restructuring appointments. We are seeing bankruptcies pick up across the board. the mezzanine areas of the private credit market, which are typically reasonably opaque. There's definitely some default and restructuring activity going on in that part of the world. And that's not such a bad thing. I mean, this was, I always call it, it's the fish that John West rejects. These are the slices of credit that have come off bank balance sheets. They've gone into firmer hands or in the non-levered part of the non-banking part of the investment community, and they're arguably better placed to deal with the risks that are in that area. But it does feel to me that if you were going to pick an area of the market that was ultimately going to be dislocated, or you're starting to see early signs of stress, it's definitely in that area. And I think just underwriting activity, capability has been a little bit amiss in particular parts of that area. It's not to say that all private credit areas should be painted with the same brush. It's just what we're seeing in particular in Europe, and also in that mezzanine part. I think ultimately government bonds aren't a bad place to be. The real yield, as we were talking before, on US tips at the moment on the 10 years up around 2.25. A real yield in a government bond at that level is pretty good after inflation. So I don't think that's an area that people should avoid. Yes, you do have to take a little bit of duration with it, but arguably you're getting pretty well compensated for inflation risk, and also that inflation risk premium that's starting to creep back into markets. I think corporate bonds in this sort of area, very tight spreads, not a lot of risk compensation in that area of the market at all. I think you want to be very selective about what you're leaning into there. Securitized assets in these sorts of areas, they are incredibly tight markets at the moment. Not a lot of liquidity, not a huge liquidity premium there is on offer. So I think you want to be pretty careful in those parts of the market as well.
Congratulations on your outstanding performance of your funds over the years they've been operating. And I was just reading about your default rate arbitrage strategy that you use in the real income fund, and that you had made good returns from 3 corporates that defaulted restructured last month. Can you just explain how that works?
Yeah, so look, we aim to employ strategies that systematically take advantage of improvements in the default system. So since the financial crisis, we've had some significant developments and microstructure improvements, such as clearinghouses, are now the conduit for taking in a lot of that bilateral risk that used to sit out there between asset managers and the sell-side banks. That's, in my view, fostered a huge amount of liquidity in the default system. And that's really enabled strategies to be developed around defaults without the bilateral risk that you would have typically had by facing off against a particular bank. They've introduced a global repository / graveyard, I call it, for all corporate defaults. And now we've got a thriving default auction system, which works really well. And that's harmonized what was otherwise a very messy and complex process. When corporates or countries defaulted, our area of specialty is in that particular microcosm. We seek to try and use those defaults as a mode of generating alpha in our strategies. Systematically, we use it as a ballast within our portfolios. We always say avoidance is not a strategy. There's nothing wrong with leaning into a particular area of the market if it allows you to do so, and that's our argument that it does now. And ultimately, they should provide you, very good non-correlated types of returns through time if you develop those processes and systems well, and make sure that you got the right type of risk approach to how you manage the huge amounts of uncertainty that tend to be wrapped around default environments. But really, what you want to get to is, at least with our strategies, we're trying to make money out of initial spread widening, but then also the loss upon default as well is quite important for our strategies. So we want to systematically try and use a probabilistic way of, capturing those things, but also taking advantage of what we see as this structural decline in recovery rates across high yield corporate defaults. And what I mean by that is, I think people would be surprised that, systematically across high yield bonds, you've basically got a 30-cent recovery rate. But what you start to see in practice is that that's really not happening. Is that when we look at the default auctions, when we looked at what's actually transpiring in the small amount of defaults that have occurred since the pandemic, is that we have much lower recovery rates. And why? And that's really because there's a huge amount of intangibles sitting on sitting on corporate balance sheets. No longer do we have a world where they hold huge amounts of commercial property assets or hard assets on their balance sheet. They're basically technology companies in the main, dressed up as ultimately something else a lot of the time because of the huge amount of technology investment, web interface, all this sort of stuff. And so when they fall hard, and it does mean those recovery rates are systematically a lot lower. And so I think that's something that you can play for. Getting your investors at the doorstep of that opportunity can be particularly fruitful, particularly when all your other risk assets aren't doing well. So we do like that type of strategy, and try to spend a lot of time from a process perspective and risk perspective, getting access to those opportunities. So it was great to see in March that we started to get some restructuring going on in Europe, and that obviously fed through strongly into our performance, and has been feeding into our performance over the first part of the year, the first quarter of the year as well. So that's an area of the market that we really want to target and develop through time.
It's just fascinating that you can still be making money when companies do default, and there is that arbitrage opportunity, and you're taking advantage of it. It's excellent. Have you got any thoughts about future defaults, and do you see rates rising?
Undoubtedly, when you look across most of the bankruptcy data, particularly in the US, which tends to be more of our focus, you are seeing defaults, corporate defaults in the US on par with what we saw in 2020. So I think that's a really interesting point, because defaults in that area of the market, at the grassroots level, are on par with arguably one of the worst default periods that we've had in history. And yet what we see in the capital markets is we see no defaults in the public capital markets in 2024. So we've got a significant disconnect between what we're seeing at the grassroots level and then what we're seeing in public markets at the moment. Yes, we are starting to see some restructuring appointments, and we're starting to see a fair bit of friction in that area. But we're off to a racing start with bankruptcies and defaults and Chapter 11s in the US and also Europe. And we just aren't seeing that actually coming through in the public markets yet. So we think that is a huge opportunity to play for. We think that also the recovery rates is something that people should play for. And I think ultimately what it's going to mean is that the capital market volatility will pick up once it becomes very evident that these unproductive businesses that have been kept alive for so long on the back of negative real rates and fiscal largesse from the official sector, that we're going to start to see the rubber hit the road in terms of these defaults. But I think this all sort of ties into an overall macro view, and it sort of also ties into what we're talking about with inflation, is that if you keep unproductive businesses alive, at some point you're going to get a catch up with that. And if you keep unproductive businesses alive, that ultimately has huge effects on inflation as well. Obviously, the RBA and most central banks have talked about the slow or the lower level of productivity in the economy at the moment. And that is a function of keeping suboptimal businesses alive. There just has to be a price to pay. The price to pay is lower productivity, is higher unit costs for that productivity. And ultimately, that's not good for inflation. And that's where we're at. But what has to happen, that rebalancing mechanism has to play out in some way. So how do we get more productivity? And how do we ultimately iron out this wrinkle that's in the economic system at the moment? Probably the quickest way that it's going to happen is through a default cycle. We can sit here on the one hand and say, well, we expect our politicians to solve the productivity conundrum. Or we can say, you know what, that's pretty much unlikely. Arguably, the more painful way and the more realistic way that productivity is going to be resolved is that we have more corporate defaults, and those business models that really shouldn't have stayed alive do start to slowly wind down through time. And that's actually how we resolve the productivity issue in the economy at the moment.
We've just seen some Australian businesses go into administration recently. So you can get a sense that it's starting to happen here as well. So thinking about current markets, and we've talked a little bit about your default rate arbitrage, but how are you positioning your portfolio for what you expect to happen?
Yeah, well, I think, look, the most pleasing thing from where we see or where we sit with what's happened with the term structure is that interest rates have obviously gone up. That's hugely beneficial for our type of strategy, because it allows us to cross-subsidise the negative cost of being systematically involved in the default market. So when we had interest rates at zero, and you don't have a term structure to play with, you had to be much more creative in the way that you generated your alpha. As interest rates go up, you can effectively use risk-free assets to cross-subsidise your cost of insurance. That's incredibly lucrative from where we sit. So we like interest rates going higher. We like inflation being out of the band and pushing interest rates higher, because ultimately it drives that cost versus reward outcome for our portfolio. So that's incredibly significant from where we sit. So we want to keep leaning into government risk, particularly in that 1 year part of the curve. We like that area because it's more an opportunity cost part of the curve. If you're sort of venturing out into the 5, 6, 7 year, 8 year, 9 year, 10 year part of the curve, that's when you start to get much more capital volatility. That's not really an area that we want to get involved in. So really positioning the investor towards opportunity cost is a really good way of driving good risk-adjusted outcomes for the investor. And so anything where we can achieve that type of outcome, we tend to position ourselves towards. So that does mean typically short-end securities, and it also means we see great value in the non-linear part of the world, or the non-linear credit space, which is sort of fancy speak for all the parts of the credit market that don't move on what we call a delta one basis, i.e. they don't just lose money when bond spreads go out. They've got varied outcomes as systematic risk starts to change. We like that particular part of the world as well. That's an area that we spend a lot of time on. We believe we can use a lot of our development work and our quant work to solve those problems and to make money out of those markets. And so they're the areas that we're very much focused on: inflation, term structure through government bond yields or government risk-free rates. Defaults is a given for us, and yeah, they're the major factors at the moment.
Christian, that's excellent. There's so much to take in there. I'm sure our listeners are loving this podcast. Is there anything else you'd like to add before we wrap up?
No, I think that's really the major thing. I think probably as something I alluded to before, which I think is really exercising our minds at the moment. I think we're starting to see those dislocations in Europe, but I think people would be surprised by the fact that we're now starting to see the biggest disconnect between CCC credit in Europe versus BB credit than we've ever seen. And so we've never seen a larger gap, even through GFC, Euro breakup risks, pandemic. We are really starting to see some serious distress in particular areas. So cracks are appearing. I think just the thing that we're trying to solve for is this like an SVB type crack, i.e. does it ultimately get resolved, or is this more fundamental and much more symptomatic of higher interest rates, higher cost of capital, and these sorts of things. The one thing that I'm convinced by is that the CCCs aren't coming down in yield. It's more a question of how speedy the BB re-rate and the higher parts of the capital structure, or the better credits, start to re-rate relative to that CCC type of move that we've seen. I think that's ultimately where markets will go, in my view, particularly on the credit side. And I think the speed at which that happens will ultimately feed into equities. It will feed into private credit, because the CCC area of the market in the public space, there's a lot of overlap with private credit as well, because typically they will have a presence or a foot in both camps, because they don't always get access to public markets, the CCC issuers. So I think they're things worth calling out and paying particular attention to through time.
Thank you so much for your time today. We really appreciate it, and we hope you'll be back in another year or so to keep us up to date, give us an update.
Thanks so much, Liz. Really appreciate it.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au, and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran, and we'll see you next episode on Fixated, the Fixed Income Podcast.